After watching this video, you will be able to list the common forms of business organizations, discuss the advantages and disadvantages of each form, briefly explain what agency problem is, and one simple way to solve it. Let's start off by looking at the common types of business organizations. Broadly, they may be classified into three: sole proprietorships, partnerships, and corporations. In a sole proprietorship, a single individual, who typically tends to also be its manager, owns 100% of the business. Note, in this course, manager typically refers to the company's CEOs and other CXOs. However, there are a number of disadvantages with this form of a business organization. One is that the individual has unlimited liability. That is, if the business goes bankrupt, the owner may end up losing even her personal wealth while paying off all creditors. Two, it is difficult to raise capital as there is no required financial reporting. Outside investors will have no idea about how well or badly the company is performing. Also, the life of sole proprietorships may be limited to the life of the owner. No one may be willing to take over the ownership of the sole proprietorship after the owner's death. One advantage of a sole proprietorship is taxation. The owner does not have to pay corporate taxes. She will have to pay taxes at the personal income tax rate. A second form of a business organization is partnership. Here, two or more individuals come together to form a partnership. All advantages and disadvantages of sole proprietorship apply to partnerships also. Partners are subject to unlimited liability and will also find it difficult to raise capital. They are taxed at personal income tax rates. A third form of a business organization is a corporation. This form solves the two disadvantages of sole proprietorships and partnerships, namely unlimited liability and difficulty to raise capital. Owners of corporations are subject to limited liability, that is, they can lose only how much they have invested in the company and nothing more. Further, corporations have to mandatorily release financial statements periodically. So outside investors know the financial health of the company at any point in time. This makes raising capital for the company much easier than sole proprietorships and partnerships. However, corporations have their own disadvantages. The shareholders of a corporation are its owners. Since there are usually thousands or even millions of shareholders in a corporation, they appoint managers to take care of the day-to-day operations of the corporation. The managers are agents acting on behalf of the shareholders. This leads to what are called agency problems, where the managers act in their own interests rather than in the owner's best interests. Sole proprietorships and partnerships typically do not have agency problems as the owners are also their managers. An example of an agency problem is managers using the company's money to buy themselves an expensive vacation home which will not yield any financial benefits to the owners. There are ways to solve this agency problem. A common one is to make managers part owners in the company by offering them shares as part of their compensation package. Since the managers are now owners, their interests are aligned with other owners, and so they will work in all owners' best interests. Another disadvantage of a corporation is double taxation. The corporation pays taxes from its profits at corporate tax rates. If it pays dividends to its shareholders, then these dividends are also taxed. In some countries, the company pays a dividend distribution tax. In other countries, shareholders are taxed at the personal tax rate on any dividends earned. Either way, the same stream of cash flow, company's profits, are taxed twice. Remember that this is not the case with sole proprietorships and partnerships, where the owner-managers are taxed at the personal income tax rate. In this course, we will focus only on corporations as they are subject to mandatory financial reporting. Also, since they attempt to raise capital from outside investors, they must have an intuitive way to identify profitable projects to invest in. Next time, we will look at what the role of the financial manager in a corporation is.